Accounting principles are the rules and guidelines that companies and other bodies must follow when doing financial accounting. What are the accounting principles? They are the basic concepts that control the accounting practice. Also, they provide us the structure to control, record, organize, and report the financial information. The contents we're gonna discuss here are principles of accrual, consistency, materiality, prudence, going concern, monetary measurement, historical cost, full disclosure. Accrual. Businesses may come across many scenarios in which the cash is exchanged at a later stage. Therefore, the need is to record the transactions accurately. For instance, a company is selling product on the 1st of January on credit and get the money 3 months later. At 30th of March, let's take an example. It has to record the income earned at the 1st of January when the sale is done without waiting for the actual exchange of cash. Same is done when a company is purchasing on credit. There comes an expense and it should be recorded when the purchase contract is made. It is the time when the expense has really incurred. So that means accrual concept says that the transactions should be recorded when they are incurred or earned, irrespective of the actual exchange of cash. So in other words, we can say accrual accounting actually follows the matching principle. In matching principle, as the name suggests, that the revenues and expenses are matched in the time when they are incurred or earned. This principle ensures financial statements reflect the economic activities of a company accurately. Consistency, consistent accounting methods and principles. We have to make a trend analysis. We have to compare the accounting statements from one year to the other. So this comparability and reliability requires consistency to be there. Principle of materiality. A financial information should be presented and disclosed if it has a significant impact on the decision making of users. What does that mean? The amount of information, the amount of transaction, anything that has a substantial value in itself should be recorded. The trivial amounts, the smaller amounts should not be recorded because it will not gonna help the investors in their decision making. For example, there is a big business, it has millions of dollars of worth, so $100 might not have a significant worth to be recorded in the financial statements. So in the small business which have 100,000 of the dollar value, it may have $100 as a significant portion of its value, so they may consider recording it. Therefore, the determination of materiality depends on the nature and amount of an item. Prudence suggests that when there are uncertainties or alternative accounting treatments available, accountants should be cautious and choose the option that understates assets or income. Let me explain through an example. For instance, a company is expecting payments next month. Probability is very high, they'll most likely be able to get those payments, but it will not record it because it is a cautious behavior that unless you actually receive the payment, you should not record it. Conversely, if you expect losses in the next month, you will record a provision regarding that you will most likely to encounter losses in future. So this is more likely a cautious behavior which conservatism or prudence concept endorses. This is because a business should portray the exact picture of their financial statements. They should avoid any sort of overstatements. Going concern. This principle assumes that the business will gonna operate for the foreseeable future, and obviously people think that it will gonna operate indefinitely unless there is an evidence that there will be a hindrance in the future. and there is an evidence to the contrary about the concepts we have just discussed. So, this type of principle actually allows the businesses to record their assets at historical cost and assumes that the company will gonna operate in the future and they will realize their benefits as well in the upcoming time. Monetary measurement. This concept states that the financial transactions can be and should be recorded in a monetary unit, in a currency. This is because we have to quantify this information, and unless we record it in the currency, it can't be understandable for the local community, especially the business that in any territory a business is taking place. Recording in a currency will also able to convert it into different currencies if we are more likely to understand it in the global perspective. The principle of monetary measurement ensures the adherence of this concept. Historical cost. An asset should be recorded, but at the cost that it is acquired initially. It provides objectivity and verifiability to a financial statement. Full disclosure. Companies and businesses usually disclose their information to external stakeholders through financial statements. These financial statements should be included with all of the significant information that is necessary to convey and inform people whose interest is associated with our business.